Methods of e-payments. Various methods of e-payments available in India are credit card, debit card, smart card, e-wallet, and net banking. Credit cards. Credit card is a plastic card with a magnetic strip issued by a bank or financial institution entitling its holder to purchase goods and services. It is called a credit card as it enables its holder to purchase now and pay later on, usually within a month. It is often used as a form of short-term financing. Credit card company fixes the credit limit for every card holder depending upon his credit worthiness and past payment record. The maximum amount a cardholder can spend is up to the credit limit and not beyond that. The credit card company generally does not charge any fees from the holder for making credit purchases if the payment is made within the grace period. However, the credit card company recovers its costs through the following: 1. Annual fees from the customers, although it is very marginal. Second, interest is charged at a considerable higher rate by the credit card company on the due amount if it is not paid within the grace period. Third, interchange fees charged to merchant every time holder uses the card to make payment to the merchant. Merits of using credit card. First, ease of use. Credit cards when used even before the advent of e-commerce, so people had already gained confidence about the safety and security of credit card usage. Second, low processing cost. Since the holder has to pay annual charges which are marginal, credit cards come across as a low-cost payment option. Third, convenience. It frees the customer from the hassles of carrying cash. A customer can carry a small card in his or her wallet and can make purchases worth thousands of rupees. Fourth, means of short-term financing. Credit card enables a customer to make purchases even though he may not have liquidity at that time. He may purchase on credit and pay later within the grace period allowed by the credit card company. Fifth, additional benefits. Additional benefits like cashback, reward points, free insurance cover are also provided by the card companies to gain competitive advantage. Demerits. First, overspending. Credit card may result in spending by a customer beyond his budget. Ease of use and convenience to pay later may encourage customers to purchase goods which they do not need at all or may need later. Second, high interest rates. Credit available is not free of cost. When a customer purchases on credit, he needs to pay within the grace period allowed by the company. If the payment is not made on time, then the customer is forced to pay very high interest on the amount due. Third, risk of losing card. If the customer misplaces, loses a card, or his or her card gets stolen, there is a risk of purchases being made through that card. So he has to get the card hostiled at the earliest. Credit card security and encryption. SET protocol. Secure Electronic Transaction (SET) is the protocol for ensuring the security of financial transactions on the internet. SET enables the credit card information to be sent to all parties right from the customer to merchant, then from merchant to merchant's bank, and from merchant's bank to credit card issuing bank in an encrypted form. SET is not a payment system, rather it is a set of protocols that allow the credit card information to be transmitted safely and securely on an open network, that is, the internet. The system is jointly managed by Visa and MasterCard through many companies like IBM, Microsoft, Netscape, RSA, and VeriSign were involved in developing the protocol. Key features of SET protocol are: first, confidentiality of information. As soon as the cardholder enters his credit card information, it is encrypted. The merchant server never sees the card information in plain text. So throughout the process, the credit card information travels over the network in encrypted form. Second, integrity of data. The cardholders send to the merchant basically three details: credit card particulars, payment instructions, and order details. SET protocol ensures that information is not corrupted or tampered during transmission. Third, authentication. The protocol enables the merchant to verify that cardholder is the legitimate user of the valid credit card. It also certifies that a merchant is authorized by his bank to accept credit card payments. Fourth, interoperability. This protocol enables the transaction to be conducted across different platforms and networks at any time, that is 24/7 without delay. Debit card. Debit card is a plastic card that provides the holder electronic access to the savings account. Debit card functions as debit card as well as ATM. Holder can withdraw money from ATM as well as to make purchases both at retail store as well as online via debit card. When debit card holder uses the card, his account instantly gets debited and he need not pay anything to settle his account later on. Its effect is equivalent to cash. It relieves the customer from the burden of carrying cash besides providing array of benefits like cashback, bonus points, reward points, free insurance cover and many other benefits. Like credit card, a debit card issuer bank may have tie-up either with Visa or MasterCard. In India, NPCI, National Payment Corporation of India, has launched a domestic card scheme known as RuPay debit card. It can be used for online purchases and also functions as ATM card under National Financial Switch Network. Difference between credit card and debit card. Points of distinction: credit card, debit card. The first point of distinction is mode of payment. Credit card. In case of credit card, purchases are made on credit. Debit card. In case of debit card, purchases are directly charged to the purchaser account and his balance gets deducted by the amount of purchase. The second point of distinction: bank account. Credit card. Purchaser need not have a bank account with the credit card issuing bank. Debit card. Purchaser must have an account with the bank issuing debit card. Third, interest charges. Credit card. Interest is to be paid if amount due is not paid within the grace period. Debit card. No interest is to be paid as goods and services are not purchased on credit. Fourth, issue of card. Credit card. A person has to apply for getting a credit card. Debit card, debit cum ATM, is issued to the customer as soon as his account is opened. Smart card. Smart card, like debit and credit card, is a plastic card with embedded microprocessor chip. It also contains integrated circuit and non-volatile memory. Smart card was first introduced by Motorola in 1977. It is used for storing information and authentication. Smart card, unlike debit or credit card, may store a lot of personal and confidential information about the card holder. In India, various examples of smart card are PAN card, Aadhaar card, which is also known as unique identification number, identity card of the employee, or the Metro card, which we frequently use. Types of smart cards. Smart cards are of two types. First, contactless cards. These cards do not require to be swiped through a magnetic strip reader. Its embedded integrated circuits can store and sometimes process data and communicate with the terminal via radio waves. For example, ICICI Bank launched India's first contactless debit and credit card, enabling its customers to make electronic payments by just waving the card near the merchant terminal instead of dipping or swiping it. Second, contact cards. These type of smart cards have to be inserted or touched to the card reader. For example, in case of Metro card, we touch it against the reader, which reads the information from the chip about balance stored in the card. In India, smart cards are not used as a medium of online payments, rather they are used for identification and authentication purpose. Application of smart cards in India. First, Metro card used in Delhi Metro is a smart card with embedded chips. Second, DigiCard inserted in set-top box is an example of contact smart card with smart card reader fitted into the set-top box. Third, loyalty or affinity cards used by retailers, airlines are examples of smart card. Fourth, Aadhaar card is another example of smart card. It contains a lot of personal information and other identity information of an individual. Fifth, in order to provide social security to the country's unorganized workers, the government is planning to soon issue smart cards that will provide them multiple benefits like health, insurance, pension, and banking through a single card. Next, e-wallet. E-wallet or digital or mobile wallet is similar to a traditional wallet. Like traditional wallet, it is to used to hold cash through digitally. It is an online prepaid account which can be used for various online transactions. Once the customer has transferred the cash into his wallet, he can buy a range of products from apparels, mobile recharge, paying utility bills, hotel reservations, airline tickets to ornaments, without swiping a debit card or credit card. Types of e-wallets. In India, as per RBI, there are three kinds of e-wallets: closed, semi-closed and open. First, closed wallet. A closed wallet is one that a company issues to the customer for in-house goods and services only. These instruments do not carry the advantage of cash withdrawal or redemption. Several online shopping portals such as Flipkart, Jabong, and MakeMyTrip offer such closed wallets. A closed wallet can have maximum value of rupees 5,000 only. Second, semi-closed wallet. As per the RBI, a semi-closed wallet can be used for goods and services, including financial services, at select merchant locations or establishments that may have a contract with the issuing company to accept these payment instruments. Semi-closed wallets do not permit cash withdrawal or redemption by the holder. E-wallet works under the prepaid payment instrument guidelines of RBI, which states that the wallet can be loaded up to a maximum limit of 10,000 in a month. Also, at any point of time, the balance in the card should never be more than rupees 10,000. Some of the examples of semi-closed wallets are PayUmoney, Paytime, Oxygen Wallet, and MobiKwik Wallet. Third, open wallet. Such wallets can be used for purchase of goods and services, including financial services such as funds transfer at merchant locations or point of sale terminals that accept cards. Open wallets now also allow cash withdrawals at automated teller machines and other transactions such as balance inquiry. These kind of wallets can be only issued by banks. Examples are Pockets by ICICI Bank, State Bank, Buddy, etc. Steps to create an e-wallet. To create an e-wallet, customer needs to follow the steps below. First, go to an e-wallet service provider website. Example, Oxygen Wallet. Second, click on sign up. Third, enter all required information like email ID, mobile number, etc. Fourth, an OTP, that is one-time password, is then sent to the registered mobile number. Fifth, enter that OTP and submit. Sixth, e-wallet account will be created. Seventh, to use the e-wallet thus created, the customer needs to transfer money to this wallet. Click on Add Money option. 8th, customer needs to then write the amount he wishes to transfer. 9. Select any of the available options: debit or credit card, internet banking, IMPS to transfer money in your wallet. 10th, click on Proceed to transfer money. Benefits of e-wallet. First, once a customer transfers the money to his wallet, he is free from the hassles of entering debit or credit card details every time he makes an online transaction. Second, maximum amount that can be carried in a wallet is rupees 10,000, but there is no minimum amount. For example, some e-wallets, it is as low as rupees 10. Third, also since there is a lot of competition in the payment space, various wallet service providers are offering huge benefits to the customers in the form of extra discounts, cashbacks, and reward points. Net banking. Net banking is another very popular method of online payments. To use net banking, user needs first to have an account with the bank and then obtain permission from the bank in the form of the user ID and password to operate its account electronically. Every document needs to be signed by the seller to establish. First, authentication. Authentication means ensuring that the document is sent by the person who has signed it. Second, integrity. Integrity applies, ensuring that the message is received by the receiver unaltered or intact. Third, non-repudiation. Non-repudiation means that the person later on cannot deny